Crypto promises opportunity, freedom, and life-changing wealth. Everywhere you look, there are stories of people turning a few $100s into millions. Social media posts, viral videos, and online forums make it seem effortless, almost like anyone can do it. But for every success story, there are countless more who lose money, sometimes everything they invested. So why does this happen? Why do most people fail in crypto, even when the potential seems enormous? The first reason is lack of understanding. Many jump into crypto because they see hype or trending news. They buy a coin simply because everyone else is buying it, without understanding what it actually does, the team behind it, or its real-world purpose. They don't know the difference between coins, tokens, or stablecoins. Without this foundation, every investment becomes a guess. In a market as fast-moving as crypto, guessing rarely ends well. Imagine buying a coin because your favorite influencer mentioned it, only to find out it was a scam or had no real value. This happens more often than people realize. The second reason is emotional trading. Crypto markets are extremely volatile. Prices can soar one day and crash the next. Fear and greed often dictate decisions. When prices rise quickly, people buy impulsively, driven by FOMO, fear of missing out. When prices fall, panic sets in, and they sell at a loss, locking in failure. Emotional trading replaces rational thinking, and even experienced investors sometimes make mistakes when emotions take over. Another major reason is chasing hype and trends. Social media, influencers, and online communities constantly promote the next big coin, or guaranteed moonshot. Many investors jump from trend to trend, buying at the peak and selling too late when the hype fades. The market doesn't forgive emotion-driven decisions. Meme coins, NFT projects, and viral tokens can pump in hours, only to crash just as fast, leaving late buyers with heavy losses. Poor risk management is another trap. Many people invest more than they can afford to lose. They put in their savings, emergency funds, or even borrowed money, hoping for huge returns. When the market moves against them, they are forced to sell at a loss, or worse, lose everything. Even small market swings can wipe out portfolios without proper risk control. Those who diversify, set limits, and plan for volatility are far more likely to survive. Lack of research and due diligence is a massive factor. The crypto market is full of coins and tokens with no real value. Scams, pump and dump schemes, and fraudulent projects are everywhere. Beginners often buy coins because they sound exciting or are promoted online. Without understanding the technology, the roadmap, or the team, many lose money this way. Even projects that seem legitimate can fail if their technology is flawed, their team leaves, or the market loses interest. Timing is critical. Many people enter the market too late, after prices have already risen dramatically. They buy in at the top, expecting the price to continue climbing, only to watch it crash the next day or week. Markets are unpredictable, and patience is essential. Understanding when to enter and exit and recognizing market cycles can make the difference between profit and loss. Lack of strategy is another hidden reason. Long-term holders, experienced traders, and institutional investors approach crypto with clear plans. They set targets, diversify portfolios, manage risk, and make calculated decisions. Beginners often have no plan. They trade on impulse or emotion, without a strategy. Losing money is almost inevitable. A common mistake is buying a coin simply because it looks promising, rather than having a reasoned entry and exit plan. Overconfidence is another problem. Many beginners believe crypto is easy money, or that they can outsmart the market. They ignore warnings, skip research, and assume they are smarter than everyone else. In a highly volatile market, overconfidence often leads to mistakes and losses. History is full of stories of investors who thought they could beat the system, only to lose everything in a single market crash. Even experienced investors can be caught off guard by unexpected events. Regulatory announcements, exchange hacks, or sudden moves by major investors can trigger sharp market drops. Those who are unprepared, over-leveraged, or emotionally attached often panic and sell at a loss, reinforcing the cycle of failure. Another major trap is over-leveraging. Many people borrow money to invest in crypto, thinking it will multiply profits, but leverage also multiplies losses. A small market dip can wipe out not only invested funds but also borrowed money. Over-leveraging is one of the fastest ways beginners lose everything, sometimes overnight. Despite all these challenges, losing money in crypto isn't inevitable. Education, patience, research, emotional control, and proper risk management can make all the difference. Understanding market cycles, studying the technology, and developing a clear strategy are essential to navigating crypto safely. Beginners who take the time to learn, plan, and prepare are far more likely to succeed than those chasing hype and emotions. Crypto is often a long-term game. Those who approach it with knowledge, patience, and discipline tend to perform better than those seeking instant wealth. Learning from mistakes, keeping emotions in check, and making informed decisions are key. If this story helped you understand why most people lose money in crypto, take a moment to subscribe to the channel. More deep dives into the hidden realities of digital finance, investing mistakes, and strategies for success are coming, and you won't want to miss what happens next. Knowledge, preparation, and patience are your first steps toward avoiding the pitfalls that trap so many beginners in the crypto world.